Most Americans will collect somewhere between $250,000 and $600,000 in Social Security benefits over their lifetime. For millions of retirees, it will be the single largest financial asset they ever receive. And yet, the majority of Americans make at least one decision about Social Security that permanently reduces what they collect. Not by a little, often by more than $200,000. In this video, I'm covering the 7 most common and most costly Social Security mistakes, including one involving a brand new 2026 law that millions of people still haven't acted on. Every number comes directly from Social Security Administration data and current IRS publications. Links are in the description. Let's get into it. Mistake 1. Claiming early without running the actual numbers. You can claim Social Security at 62. Millions of people do. But claiming at 62 instead of waiting until your full retirement age, which is 67 for anyone born in 1960 or later, permanently reduces your monthly benefit by 30% every month for the rest of your life. The average Social Security benefit in 2026 is $2,071 per month at full retirement age. Claim at 62, and that drops to roughly $1,450. That's $621 less every single month. Over a 25-year retirement, that difference is $186,300. And that's before cost of living adjustments compound the gap further. There's a concept called the break-even age. It's the point where waiting to claim ends up paying more in total than claiming early. For most people, that's somewhere between age 77 and 80. A 65-year-old today has roughly a 50% chance of living past 85. If you're in reasonable health, waiting almost always wins. The mistake isn't claiming early. The mistake is claiming early without running the numbers first. What to do? Go to ssa.gov, create your free My Social Security account, and pull your personal benefit estimates at 62, 67, and 70. Multiply the monthly difference by 12, then by your expected years of collection. That number is the cost of your decision. Make it with your eyes open. Mistake 2. Married couples planning their Social Security separately. Social Security has a spousal benefit. If you're married, you receive either your own earned benefit or up to 50% of your spouse's benefit at their full retirement age, whichever is higher. But here's what most couples miss entirely. The higher earner's benefit doesn't just affect their own monthly check. It sets the survivor benefit. When one spouse dies, the surviving spouse keeps the larger of the two amounts permanently. If the higher earner claims at 70 with a benefit of $3,350 per month, and that spouse dies at 78, the surviving spouse doesn't drop back to their own smaller amount. They step up to $3,350 for the rest of their life. If the survivor lives to 90, that's 12 years of $3,350 instead of perhaps $1,200. The difference is over $300,000. The optimal strategy for most couples, the lower earner claims earlier to bring in income. The higher earner delays as long as possible, ideally to 70, to maximize both their own benefit and the lifetime income protection for whoever lives longer. What to do? Model out at least 3 scenarios together. Both claim at 62. Both claim at full retirement age. And the coordinated strategy. The numbers almost always point clearly to one answer. Mistake 3. Not understanding how Social Security is taxed. Up to 85% of your Social Security benefits may be federally taxable. The IRS calculates something called combined income, your adjusted gross income, plus any non-taxable interest, plus half of your Social Security benefit. Above $32,000 combined income for married couples filing jointly, some of your benefits become taxable. Above $44,000, up to 85% is taxable. The mistake isn't just knowing this happens. The mistake is not planning around it. Every dollar you withdraw from a traditional IRA or 401k increases your combined income and pushes more of your Social Security into the taxable column. Roth IRA withdrawals are tax-free and do not count toward that threshold. Retirees drawing heavily from traditional accounts often push 85% of their Social Security into taxable territory, when a different withdrawal sequence would have kept them at 0%. That difference can be $3,000 to $6,000 per year for 20 years. What to do? Before you claim Social Security, map which accounts you'll draw from and in what order. The sequence matters enormously. Mistake 4. Never checking your earnings record for errors. Your Social Security benefit is calculated based on your 35 highest earning years. The SSA uses the wages reported by your employers. If those records contain errors, your benefit is calculated on incorrect data, and you'll never know unless you check. Errors happen. Misreported wages, income credited under a wrong name, a year completely missing from your record, self-employment income that wasn't properly filed. One missing high-earning year could reduce your lifetime benefit by thousands of dollars. What to do? Go to ssa.gov. Log into your My Social Security account. Download your earnings history. Go through it year by year against your own records, old W-2s, tax returns. If you find a discrepancy, the SSA has a correction process. This takes 30 minutes and costs nothing. Mistake 5. Working and collecting early, without understanding the earnings test. If you claim Social Security before full retirement age and you're still working, your benefits can be temporarily reduced based on how much you earn. In 2026, if you're under full retirement age for the full year and you earn more than $24,480, Social Security withholds $1 in benefits for every $2 you earn above that limit. Earn $44,480 and you're $20,000 over the limit. That means $10,000 in withheld benefits, potentially wiping out your monthly check entirely. The withheld benefits aren't permanently lost. The SSA credits them back at full retirement age. But you've already taken a permanently reduced benefit, had that reduced benefit withheld, and are waiting years for a partial credit. In most cases where you're still earning a solid income, you're better off simply not claiming until you stop working. What to do? If you plan to work past 62, run the numbers on whether claiming makes any financial sense before your full retirement age. In most scenarios with continued income, it doesn't. Mistake 6. Picking a retirement state without checking Social Security tax rules. 9 states still tax Social Security benefits at the state level in 2026. Most retirees don't know this until they've already moved. Those states are Colorado, Connecticut, Kansas, Minnesota, Montana, New Mexico, Rhode Island, Utah, and Vermont. The other 41 states, plus Washington, D.C., don't tax Social Security at all. Minnesota, for example, taxes up to 85% of benefits at state rates between 5.35% and 9.85%. That could mean an additional $4,000 to $8,000 per year, purely based on your zip code. This doesn't mean avoiding those states. Climate, family, healthcare, and quality of life all matter. But the tax bill should be in your calculations. A decision worth $200,000 over 25 years deserves 30 minutes of research. What to do? Before you finalize any retirement relocation, build a full tax comparison. Federal Social Security tax, state Social Security tax, property taxes, and sales taxes. The full picture often looks very different from the headline rate. Mistake 7. Missing the biggest Social Security change in decades, one that's still paying out right now. In January 2025, Congress passed the Social Security Fairness Act. This law permanently eliminated 2 provisions, the Windfall Elimination Provision, or WEP, and the Government Pension Offset, or GPO, that had reduced benefits for millions of Americans for decades. Who was affected? Teachers in states where teachers don't pay Social Security taxes, police officers and firefighters, Federal employees under the Civil Service Retirement System, state and local government workers in roughly 15 states. The SSA has already distributed approximately $17 billion in retroactive payments to around 3.1 million people. But here's where money is still being left on the table. If GPO would have eliminated your spousal or survivor benefit entirely, you may never have bothered applying. That benefit is now potentially available to you, but you have to apply. The SSA does not pay retroactively beyond 6 months for most benefit types. Every month you delay is a month you cannot recover. What to do? If you ever worked in a government job that didn't pay Social Security taxes, as a teacher, firefighter, police officer, or state or local government employee, and you haven't reviewed your eligibility since January 2025, do it this week. Call the SSA at 1-800-772-1213 or visit ssa.gov. The law changed. Your benefit may have changed with it. 7 mistakes. 7 chances to protect what could be the largest financial asset of your life. I've put a free checklist in the description. 14 things to verify before you file for Social Security. No email required. Just download it and use it. If this was useful, subscribe. Every week I publish specific number-based retirement education. No fluff, no products, no conflicts of interest. Next week we're covering the Medicare enrollment mistake that locks you into a permanent lifetime premium penalty. Most people don't find out about it until it's too late. I'll see you then.